Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everybody, welcome to Daily News Simplified, an answer to what, why and how of newspaper reading. Today we shall be analyzing the Hindu newspaper dated 23rd of May 2022 of the New Delhi edition. The topics to be discussed today have been presented on your screen. Timestamping for the same has been provided in the description box below. Let us begin our today's discussion. On page number 1 of today's newspaper, you have two important articles related to the taxation on the petroleum products. The first article is Centre bearing the full duty cut burden according to Finance Minister, and the second article is many states reluctant to cut the tax. The article that we are going to discuss here shall be important mainly with respect to prelims, both from the perspective of polity and governance as well as the Indian economy. Now, before I discuss as to in what way this particular article becomes important from the perspective of the prelims examination, let me first give you the background. On account of Russia-Ukraine war as well as global supply chain disruptions, the international crude oil prices have continuously been increasing. And as far as India is concerned, India imports more than 80% of its crude oil requirements. So since the international crude oil prices have increased, even in our domestic market, the prices of petrol as well as diesel are also increasing. The higher prices of petrol and diesel is in turn leading to a high rate of inflation within the Indian economy. Hence, if we have to reduce the prices of petrol and diesel, there is a need to reduce the tax rates on these two products. See, when it comes to petrol and diesel, right now, petrol and diesel are not part of the GST regime. Since they are not part of the GST regime, both the center as well as the state governments impose indirect taxes on petrol and diesel. For example, the central government imposes the excise duty. Apart from excise duty, it imposes cess in the form of agricultural infrastructure cess, road and infrastructure cess, and so on. And when it comes to the state governments impose VAT, that is the value added tax on petrol and diesel. So now the question is, who should be reducing the tax rates on petrol and diesel in order to bring down the overall rate of inflation within the Indian economy? So when it comes to central government, way back in November 2021, the central government has already reduced the tax rates on both petrol as well as diesel. For example, in the month of November 2021, the tax rates on petrol was reduced by rupees 5 per litre and the tax rates on diesel was reduced by rupees 10 per litre. Subsequently now, that is recently in the month of May 2022, the central government has further reduced the tax rate on petrol by rupees 8 per litre and the tax rate on diesel has further been reduced by rupees 6 per litre. So on account of reduction in the tax rates on petrol and diesel, the total revenue loss is around rupees 2.2 lakh crore. And according to central government, this entire revenue loss will be borne by the central government alone. So that is what the title of this particular article also highlights. This article highlights that the central government is going to bear the entire revenue loss on account of the recent tax cuts on petrol and diesel. Further, as you can see in Jan 2020, the overall central government taxes on petrol and diesel constituted 46%, whereas the state government accounted for almost around 20% of the taxes on petrol and diesel. So if you add up the center share and the state's share, it would have been around 66% of the price of petrol and diesel, which basically means that if you are paying rupees 100 for 1 litre of petrol, 46 rupees would have gone to the center and 20 rupees would have gone to the state government. But on account of the tax cuts by the center, the overall center's tax share has now got reduced to around 20.6%. So the share of central taxes has got reduced because of the two recent tax cuts from 46% to 26%. Now the central government believes that it cannot reduce the tax rates further because it is required to make the payments for the oil bonds which were earlier issued by the UPA government. So since the central government has limited window for a further reduction in the tax rates, the central government has been making a plea to the state governments to reduce the tax rates. So now the central government has said that it has reduced the tax rates and the ball is in the state's court, and the state government should reduce the tax rates on petrol and diesel in order to reduce the rate of inflation. So based upon a plea made by the central government, some of the state governments such as Maharashtra, Rajasthan, etc., they have also reduced their VAT rates on petrol and diesel. However, some of the opposition ruled states are reluctant to reduce the tax rates on petrol and diesel. Now, this is what the second article basically highlights. Now, what are the reasons for the reluctance of the state governments? Let's understand that. See, first and foremost, after the introduction of GST, most of the goods and services have now become part of the GST, which means now the state governments have less leeway with respect to imposition of taxes on goods and services. The two products on which the state governments can impose taxes are right now petroleum products and alcohol. And according to a study carried out by Reserve Bank of India, the state governments earn on an average 25 to 30% of their own revenue from these two products alone. Which means, let's say you have a government of Karnataka, and let's say this government of Karnataka is earning its own revenue of rupees 100. So out of this own revenue of rupees 100, the government of Karnataka may be earning around rupees 25 to 35 through the taxes on petroleum products and alcohol alone. And right now, as you know, the financial position of most of the state governments is quite poor. One obvious reason is on account of the COVID-19 pandemic. Apart from that, there has been delay in the payment of GST compensation from the center to the states. So on account of delay in the payment of GST compensation from the center to the state's financial position is quite poor. And that is why the state governments as such are reluctant to cut the tax rates on petrol and diesel. Apart from that, some of the state governments have also come up with a counter argument that even though the central government has reduced the tax rates once in November 2021 and later in May 2022, in spite of the reduction in the tax rates, even now the central taxes are quite higher than the rates which are prevailing in the year 2014. So the state governments have been asking that the central government should further reduce the tax rates on petrol and diesel so that the rate of inflation as such can be controlled. So as you can see, with respect to the recent tax cuts on petrol and diesel, it has created a federal tension between center and states. While the central government has been making a plea to the state governments to reduce the tax rates, however, some of the state governments are reluctant to reduce the tax rates because they do believe that their financial position is quite poor. Apart from that, they would also want that the central government should further reduce the tax rates before asking the states to reduce the tax on petrol and diesel. So based upon the recent issue between the center and states, various aspects become important from the perspective of the prelims examination. That is the present taxation on the petroleum products, the different types of indirect taxes, that is a specific duty and the ad valorem taxes, and the concept of oil bonds. Hence, as part of this particular video analysis, we shall focus on these three dimensions. So based upon our discussion, you should be in a position to attempt these four practice questions. So let us start our discussion with respect to types of indirect taxes, that is the ad valorem taxes and the specific tax. Now let us consider a particular commodity X on which there is a need to impose the indirect taxes. Now there are two ways in which we can impose the indirect taxes, that is either in the form of ad valorem taxes or in the form of the specific tax. Now let's say the price of this particular commodity is equal to rupees 100. Now in case of ad valorem tax, the tax rate is defined in terms of the value of the product, that is in terms of the price. And let's say the tax rate here is equal to 5%. So accordingly, 5% of rupees 100, that is rupees 5, you will be required to pay in the form of indirect taxes. Similarly, let's say if the price of this particular commodity increases from 100 to rupees 200, and in this case now 5% of rupees 200, that is rupees 10, you will have to pay in the form of the ad valorem taxes. So when it comes to the ad valorem taxes here, the tax collected by the government in turn depends upon the value or the price of a particular product. The best example of an ad valorem tax happens to be the GST. For example, in GST, you have rates ranging from 3% to 28%. So this percentage is defined in terms of the value of a particular commodity. So let's say the GST rate imposed on a particular commodity is 28%. So 28% of the price or the value of the product has to be paid in the form of GST. Similar to GST, even the value added tax imposed by the state governments on petrol and diesel is also a form of ad valorem tax. For example, let's say in case of Delhi, the value added tax on petrol and diesel is equal to 20%. The price of petrol and diesel is equal to rupees 80, and let's say you are paying rupees 20 in the form of taxes to the central government. So the base here on which the VAT will be imposed would be rupees 80 plus rupees 20, that is rupees 100. So on this particular base, you will be required to pay the VAT 20%, that is rupees 20, to the Delhi government. So please do understand here, the base on which the value added tax is calculated, it includes the base price of petrol and diesel and the central taxes. So whatever is the base, a certain percentage of that base would have to be paid in the form of the state value added tax to the concerned state government. So since the tax rate is defined in terms of value or the price of a particular product, so as the price of a particular product increases, there would be increase in the tax collection of the ad valorem taxes. Apart from that, as the demand for a particular commodity increases, more number of people will buy such a commodity, and accordingly the tax collection, that is the ad valorem tax collection of the government, would also increase. So as far as the ad valorem taxes are concerned, here as I stated before, the ad valorem taxes are defined in terms of the value. They are not defined in terms of the per unit of a particular product. So irrespective whether you buy one product, two products, three products, or so on, you are required to pay a tax rate which is as per the price of a particular product. But when it comes to specific tax, here in case of specific tax, the tax rate is defined in terms of per unit of product. For example, let's consider the same commodity X, and on this commodity X, let's say the government has imposed a specific tax of rupees 10 per unit of commodity X, which means for every 1 unit of X that you buy, you will be required to pay rupees 10 in the form of specific tax. So if you buy 2 units of this product X, you will be required to pay rupees 20. If you buy 3 units, you will be required to pay rupees 30. So here the tax that you are required to pay is dependent upon how many products are you buying. It is not dependent upon the price of the product per se. Now for example, right now the central government imposes the central excise duty on petrol and diesel, which is in the form of specific tax. So clearly you can see here, when the state governments impose VAT on petrol and diesel, it is in the form of ad valorem. Whereas when the central government imposes the excise duty, it is not in the form of ad valorem, rather it is in the form of a specific tax. For example, right now, the central excise duty on petrol and diesel after the recent tax cut, this is rupees 19.9 per litre. So whenever you are buying 1 litre of petrol, the tax that you will be required to pay to the central government would be rupees 19.9 per litre. If you are buying 2 litres of petrol, it will be 19.90 into 2. If you are buying 3 litres of petrol, it will be 19.9 into 3. So here the tax that you are paying to the center is in turn dependent upon how many units of petrol you are buying. It is not dependent upon the existing prices of petrol in the market. Similarly, the central excise duty on diesel right now after the recent tax cut is rupees 15.8 per litre. So since the specific tax is defined in terms of per unit of product, so the overall tax collection in turn depend upon the volume of sales. Now what would happen if there is increase in the prices of petrol and diesel when it comes to specific tax? See, whenever the prices of petrol and diesel increase, here you are required to pay the tax not in terms of prices. Here you are required to pay the tax in terms of how many liters of petrol and how many liters of diesel you are purchasing. So even though the prices of petrol and diesel may increase, the tax that you are required to pay to the central government, that is going to remain the same. For example, let's say earlier the price of petrol was equal to rupees 100. So earlier you are required to pay 19.9 per liter of petrol that you are purchasing, and let's say now the petrol prices has increased to rupees 200. So even though here the prices of petrol has increased to rupees 200, you will continue to pay rupees 19.9 per liter of petrol that you purchase. So that is why the specific tax as such is not impacted much by increase in the prices of product. But just like ad valorem tax, as more number of people purchase more of petrol, more of diesel, the specific tax collections of the government would also increase. Now coming to the last and most important question, that is, between the ad valorem taxes and specific tax, which of these two taxes would lead to a high rate of inflation? That is, which of these two taxes will contribute to the higher inflation? Now for example, let's say the inflation in an economy is rising. Now which of these two taxes will lead to a further increase in rate of inflation? That is a question for which we are trying to find out the answer. Now it is being said that between the ad valorem taxes and the specific taxes, it is the ad valorem tax which will have a much higher impact on inflation. Let's understand how. Now let's say the VAT on fuel is equal to 5% and the fuel price is equal to rupees 100. So the VAT which you are required to pay would be 5% of rupees 100, that is rupees 5. So total market price would be equal to rupees 105. Now let's say the VAT rate has continued to remain same at 5%, but the fuel price has doubled to rupees 200. Earlier you are paying only 5 rupees in the form of tax, that is the VAT, but now because the fuel prices have increased, the tax that you will be required to pay will also double to rupees 10. So since the tax that you are required to pay has also doubled, the market price will further increase to rupees 210. So as you can see, already the fuel prices has increased from 100 to 200. And on top of that, because of the ad valorem taxes, the prices are further increasing to 210. When it comes to specific tax, the specific tax will have a minimal impact on the inflation. Let's understand how. Let's say earlier the central government was imposing rupees 5 excise duty on petrol, and the petrol price earlier was rupees 100. So the excise duty which you are required to pay to the government was rupees 5. So total market price would now increase by 5 rupees, that is 105. And let's say now the fuel price, that is the petrol price, has increased to rupees 200. It has doubled. But here you'll continue to pay rupees 5 excise duty on per liter of petrol that you are buying. So total market price would increase by only 5 rupees. So earlier also the market price was increasing by 5 rupees because of the specific tax. Now also the market price is increasing by just 5 rupees because of specific tax. That is why the specific tax has a minimal impact on inflation. On the other hand, in case of ad valorem taxes, earlier the market price was increasing by 5 rupees, but now the market price is increasing by 10 rupees. And that is why we say that the ad valorem taxes have a much higher impact on inflation in comparison to the specific tax. Now coming to the components of different central taxes in petrol and diesel. See, as stated before, the central government imposes a specific tax on petrol and diesel. So if you look at the specific tax on petrol and diesel before the recent tax cut, that is before the recent tax cut in May 2022, this used to be rupees 27.9 per liter on petrol and rupees 21.8 per liter on diesel. And when you look at the breakup of different taxes on petrol and diesel, the central government basically imposes 4 taxes on both petrol and diesel. These 4 taxes include the basic excise duty, the special additional excise duty, the agriculture infrastructure and development cess, and road and infrastructure cess. So when it comes to petrol, 1.4 rupees that you pay is in the form of the basic excise duty. 11 rupees used to be in the form of the special additional excise duty. 2.5 per litre was in the form of agriculture, infrastructure and development cess, and rupees 13 per litre was in the form of road and infrastructure cess. The breakup as far as diesel is concerned, it has been shown on the screen here. So as you can see here, out of these four taxes, only the basic excise duty is distributable between center and states. So whatever excise duty the central government collects, that is distributable between the center and the states based upon the recommendations of the Finance Commission. But when it comes to the special additional excise duty, agriculture, infrastructure and development cess, and road and infrastructure cess, the entire revenue goes only to the center. This revenue which the central government collects from these three taxes, that is not distributable among the states. So as you can see, majorly the central government is earning revenue from the road and infrastructure cess, the agriculture, infrastructure and development cess, and the special additional excise duty. But these revenues as such, they are not distributable between the center and states, and the entire revenue goes only to the center. Only this 1.4 rupees that you pay on per litre of petrol in the form of the basic excise duty is distributable between the center and the state governments. So now, that is in May 2022, the central government has decided to reduce the tax rate on petrol by rupees 8 per litre, and the tax rate on diesel has been reduced by rupees 6 per litre. The question is, when it has reduced the tax rates on petrol and diesel by 8 and 6 respectively, which of these components has actually been reduced? Whether it is road and infrastructure cess, whether it is agriculture, infrastructure and development cess, or the special additional excise duty. Now this particular breakup here shows the components of the different central taxes in petrol and diesel after the recent tax cut. So as you can see now, after the recent tax cut of rupees 8 per litre of petrol, now the tax rate is 19.9 per litre, and on diesel it is 15.8. And if you compare the previous tax with that of the new tax, between these two, you can clearly see that the central government has reduced the road and infrastructure cess in case of petrol by rupees 8 and in case of diesel by rupees 6. That is why you can see clearly here, earlier the road and infrastructure cess on petrol used to be 13, now it is reduced by 8 to rupees 5. Earlier the road and infrastructure cess on diesel was 8, now it has been reduced by 6 to rupees 2 per litre. So these three tax rates, they have continued to remain the same as they used to exist before, but only the road and infrastructure cess has been reduced. And as stated before, the entire revenue earned by the center through the road and infrastructure cess goes only to the center. It is not distributable between the center and states. And now the central government has reduced the road and infrastructure cess, which means that whatever tax revenue loss which the central government is going to incur, that entire tax revenue loss is going to be incurred only by the central government alone. So earlier, the state governments used to get a share of 1.4 per litre of basic excise duty on petrol. Now also they will continue to get a share of 1.4 rupees basic excise duty on petrol. Their share of revenue as such has not reduced. But the amount of revenue which the central government used to earn through the road and infrastructure cess, this has got reduced. Earlier, it used to earn rupees 13 per litre, but now they are earning just 5 rupees per litre. Now coming to last topic of oil bonds. In order to understand about the oil bonds, we would have to go back to prior to the year 2010. That was the time when the UPA government was in power. When the UPA government was in power, it used to follow a mechanism known as the administered price mechanism in order to provide for subsidies on petrol as well as diesel. As part of such an administered price mechanism, oil marketing companies, let's say the Indian Oil Corporation, they were forced to sell petrol and diesel below the price at which they used to import petrol and diesel from the international market. So whatever loss the oil marketing companies used to suffer, they were referred to as under recoveries, and these under recoveries was supposed to be compensated by the UPA government. Now let's understand this particular flow through an example. Now let's say the Indian Oil Corporation is importing 1 liter of petrol at rupees 100 from the international market. But since the UPA government used to provide subsidies on petrol, the Indian Oil Corporation was forced to sell petrol at say rupees 80 in our domestic market. So as you can see here, the Indian Oil Corporation is suffering a loss of rupees 20 on every 1 liter of petrol which it is selling in the domestic market. So this 20 rupees loss, it was referred to as under recoveries, and it was supposed to be compensated by the UPA government. Now the problem is, if this 20 rupees was directly paid from the Consolidated Fund of India, then the overall expenditure of the UPA government would have got increased. And as the expenditure increased, the fiscal deficit of the UPA government would also got increased. Hence, in order to keep this fiscal deficit under control, the UPA government started issuing what is referred to as the oil bonds. So here the UPA government should have paid this 20 rupees directly from the Consolidated Fund of India. But if it would have paid this 20 rupees from the Consolidated Fund of India, then the fiscal deficit of the government would have got increased. Hence, what the UPA government then did was, this 20 rupees, it was not paid directly from the Consolidated Fund of India. Rather, the UPA government issued a oil bond with a face value of rupees 20 to the Indian Oil Corporation. It used to have a maturity period ranging from 15 to 20 years. So they are basically long-term government securities. It used to carry a rate of interest which used to be usually higher than the normal government securities. For example, the rate of interest in the oil bonds was in the range of 6.5 to 8.3%. So let's say here the Indian Oil Corporation has been issued a oil bond worth rupees 20. Its face value is equal to rupees 20. This oil bond would have a rate of interest ranging from 6.5 to 8.3%, and it is a long-term government security whose maturity period is ranging from 15 to 20 years. So here the Indian Oil Corporation has basically two options. One, it can hold on to this particular oil bond in its balance sheet. If it holds on to the oil bond in its balance sheet, then every year the Indian Oil Corporation will be able to get the rate of interest ranging from 6.5 to 8.3%. And once the maturity period ends, that is after 15 to 20 years, it will get back the entire principal amount, which in this case is rupees 20. That is option 1. The second option here for the Indian Oil Corporation is, it could sell this particular oil bond to a particular bank. So here, immediately by selling this oil bond to the bank, the Indian Oil Corporation would be able to get the principal amount of rupees 20. So in this case, the bank here will hold on to the oil bond until the maturity period. So every year, this particular bank will earn a rate of interest on this oil bond. And once the oil bond matures after 15 to 20 years, it will be able to get back the entire principal amount. But please remember here, in the second option, wherein the oil marketing companies sell the oil bonds to the banks, the oil bonds cannot be considered to be part of the SLR. So as you know that banks are supposed to keep a certain percentage of depositors' money in the form of SLR, and SLR is to maintain in the form of cash, gold and government securities. So here when I say government securities here, the government securities could include the treasury bills, cash management bills, dated bonds issued by the central government, or the state development loans issued by the state government. But here the oil bonds cannot be considered to be part of the SLR. Apart from that, the oil bonds, they were not considered to be part of fiscal deficit, but they were considered to be part of the overall public debt. What does this mean? So here, if the UPA government had issued an oil bond worth rupees 20, this 20 rupees was not considered to be part of fiscal deficit. Hence, the UPA government was able to keep the fiscal deficit under control. But please do remember here, this 20 rupees will be considered to be part of the public debt of the central government. It is considered to be public debt because once the oil bond matures, the government is then required to pay back the entire principal amount. Now, if you look at the present status of the oil bonds, from the year 2010, the UPA government decided to put an end to the practice of issuing the oil bonds. So after the year 2010, oil bonds have not been issued by the UPA government. But as I said, the oil bonds, they have a longer maturity period ranging from 15 to 20 years. So some of the oil bonds which have been issued in the year 2010, they are going to be matured between the years 2023 to around 2025-26. And now the NDA government is in power. So as you can see, prior to the year 2010, the oil bonds were issued by the UPA government, but now the NDA government is in power. And now the NDA government is required to repay the principal amount on these oil bonds. The question is, from where can the NDA government get the money in order to repay the principal amount on these oil bonds? So right now, if you see the total outstanding amount which is to be paid on the oil bonds, it is around 1.3 lakh crores, and this amount is to be paid in the next 4 to 5 years. So here the NDA government is of an argument that it cannot reduce the tax rates on petrol and diesel since it has to repay the principal amount of the oil bonds. And one way to repay the principal on the oil bonds is to mobilize higher taxes on petrol and diesel. So that is why the oil bonds was in news recently and hence becomes important from the perspective of your UPSC prelims examination. So based upon our discussion, please have a look at these 4 practice questions and let me know the answer in the comment section given below. This particular article appears on page number 1 of the text and context page. The article is titled as The Case Against Mehul Choksi. The article that we are going to discuss here shall be important mainly with respect to prelims under the subsection of both polity and governance as well as Indian economy. Now this particular article highlights that Dominica has recently decided to withdraw the legal proceedings against Mehul Choksi in a case relating to his illegal entry into the country last year. Without going into the specifics of this particular case, as far as your prelims examination is concerned, you should basically understand 2 important things. One is the concept of the willful defaulter and the other one is the concept of the fugitive economic offender. So if you know these 2 things, that would be more than sufficient as far as your prelims examination is concerned. So based upon our discussion of these 2 topics, you should be in a position to attempt these 2 prelims questions for practice. So let us start our discussion with respect to the concept of who exactly is a willful defaulter. See, willful defaulter is basically a person who has taken loans from a bank and such a person fails to repay the loans. So it is the Reserve Bank of India which has come out with the detailed guidelines with respect to the declaration of a particular person as a willful defaulter. And this declaration is actually under a scheme which is notified by the Reserve Bank of India. So please do understand here that with respect to declaration of a person as a willful defaulter, we do not have any legal framework per se. So here the declaration is done based upon the guidelines issued by the Reserve Bank of India. And these guidelines are applicable to all the scheduled commercial banks as well as all India financial institutions. So all the scheduled commercial banks as well as all India financial institutions are required to come up with a list of willful defaulter, and this particular list is to be submitted to the Reserve Bank of India. Now with respect to the criteria for identifying a person as a willful defaulter is, first and foremost, a person should have taken a loan whose minimum value is rupees 25 lakhs and above. So if a person has taken a loan which is equal to or more than 25 lakhs, and if such a person fulfills all of these criteria, then such a person can be declared as a willful defaulter. So on what basis is a particular person declared as a willful defaulter? First and foremost, a person may have taken loans more than 25 lakhs and such a person fails to repay the loans in spite of having the capacity to do so. Now, for example, let's say you have a particular person who has taken loans worth rupees 50 lakhs. This person has sufficient amount of assets. This person has sufficient amount of income. In spite of having sufficient assets, sufficient income, such a person fails to repay the loans, and in that case, such a person can be declared as a willful defaulter. Secondly, if a person has taken loans for one particular purpose and he diverts the loan for other purpose. Now, for example, let's say you have a particular person who owns two companies. One company is a profit-making company and the other company is a loss-making company. Obviously, if this person applies for loans for this loss-making company, then banks may not come forward. So what this person can then do is, this person can take loans for a profit-making company, but the loan so taken could be then diverted for the loss-making company. So if a person takes a loan for one company and diverts a loan for other purpose, in that case also such a person can be considered as a willful defaulter. Third one is siphoning of loans. It basically means that a person has taken loans for, say, expansion of a particular company, but he ends up using the loans for his own personal consumption. So the difference between these two here is, in case of diversion of loans, he is taking the loan for a profit-making company, but that loan he is not using it for the expansion of profit-making company. Rather, he is diverting the loan for a loss-making company. In case of siphoning of loans, a person is actually using the loans for his own personal consumption. And next one, as you know, when you are taking loans from a particular bank, you are required to keep a collateral. A willful defaulter is a person who sells off the collateral without the knowledge of a bank. So, a willful defaulter is a person who has taken loans whose minimum value is rupees 25 lakhs, and if such a person is fulfilling these four criteria, then accordingly such a person can be declared as a willful defaulter. And once a person is declared as a willful defaulter, accordingly legal proceedings can be initiated against such a person, and such a person will not be able to get further loans from any banks within India. So this is as far as a willful defaulter is concerned. Now coming to the concept of the fugitive economic offender. See, as I discussed before, when it comes to declaration of a person as a willful defaulter, there is no legal framework. But when it comes to declaration of a person as a fugitive economic offender, we have a law passed by the Indian Parliament known as the Fugitive Economic Offenders Act 2018. According to this particular act, a fugitive economic offender is a person who may have left India in order to avoid any kind of prosecution, or who, being abroad, refuses to return to India to face the prosecution. So you have a particular person who may have committed certain economic offenses. After committing economic offenses, such a person leaves India to avoid prosecution, or who, being abroad, refuses to return to India to avoid prosecution. Then in such a case, a person can be declared as a fugitive economic offender. The minimum value of the crime that such a person should have committed is rupees 100 crores. So here, as you can see, in case of the willful defaulter, the minimum amount of loans a person should have taken is rupees 25 lakhs. Whereas in case of the fugitive economic offender, a person should have committed an offense whose minimum value is rupees 100 crores. So what kind of crimes are covered under the Fugitive Economic Offenders Act? So this particular act has come up with a list of the crimes for which a person can be declared as a fugitive economic offender. This particular list include the printing of counterfeit currency notes, the check dishonor, money laundering, defrauding the creditors, that is the banks, tax evasion, and very importantly, as you can see, even the corruption by civil servants is also one of the crimes which has been listed under this particular act. How is a particular person declared as a fugitive economic offender? I hope all of you must be knowing about the Prevention of Money Laundering Act. Under this particular act, we have set up the Enforcement Directorate. So either the director or the deputy director of the Enforcement Directorate is required to file an application before a special court which has been constituted under the Prevention of Money Laundering Act. So once an application is filed before the special court, a notice is then sent to the person to appear before this special court. And if this person fails to appear before the court within 6 weeks, so within 6 weeks, if this person fails to appear before the special court, then the special court can then declare such a person as a fugitive economic offender. So please do understand here that it is not the enforcement directorate which has the power to declare a person as a fugitive economic offender. Rather, such a power to declare a person as fugitive economic offender has been vested with the special court which has been set up under the Prevention of Money Laundering Act. So these are some of the things which you should understand as far as the fugitive economic offenders and the willful defaulter is concerned. So based upon our discussion, please try to attempt these two practice questions and let me know the answer in the comment section given below. The next article appears on page number 10. The article is titled as Prime Minister to attend the Tokyo launch of US Trade Initiative. The article that we are going to discuss here shall be important from the perspective of prelims under the subsection of international relations. Prime Minister Modi is in Japan to attend the Quad Summit. During this particular summit, USA is set to launch its new economic initiative known as the Indo-Pacific Economic Framework. Hence, from the perspective of the UPSC prelims examination, one should be aware about various details about the Indo-Pacific Economic Framework. I hope all of you must be knowing that the Indo-Pacific region has become a bone of contention between US as well as China. Both these two countries are trying to increase their economic footprint in the Indo-Pacific region. See, as far as China is concerned, China has been able to increase its economic influence in the Indo-Pacific region by becoming part of the Regional Trade Agreement, that is, Regional Comprehensive Economic Partnership Agreement. The RCEP, as you know, it is basically a free trade agreement of all the 10 ASEAN countries and its 5 FTA partner countries. These 5 countries include China, Japan, South Korea, Australia, and New Zealand. As far as India is concerned, India also had participated in the negotiations of RCEP, but eventually decided not to become part of this regional trading agreement. So when RCEP was being proposed, that time US had proposed a counter agreement known as the Trans-Pacific Partnership Agreement. However, the former US President Mr. Donald Trump decided to withdraw from the Trans-Pacific Partnership Agreement. So in the absence of the Trans-Pacific Partnership Agreement, as of now, US does not has any kind of credible economic and trade strategy to counter the growing Chinese influence in the Indo-Pacific region. So now the Joe Biden administration in US has decided to launch a new economic initiative known as the Indo-Pacific Economic Framework at the present Quad Summit which is being held. The basic objective of the Indo-Pacific Economic Framework, just like the previous Trans-Pacific Partnership Agreement, is to counter the growing Chinese economic influence in this particular region. But you must understand here that the Indo-Pacific Economic Framework is little different from the earlier proposed Trans-Pacific Partnership Agreement. Let's understand how. When you look at the Trans-Pacific Partnership Agreement, it was more in a form of a traditional free trade agreement. So what happens in case of traditional free trade agreement is a group of countries come together and they decide on certain commonly agreed goods and services. And on these commonly agreed goods and services, they decide to reduce the customs duty in order to promote free and fair trade among these group of countries. Apart from that, the traditional free trade agreement may also seek to boost the overall investment among these group of countries. But the Indo-Pacific Economic Framework is not like a traditional free trade agreement. Rather, the Indo-Pacific Economic Framework covers different modules which include fair and resilient trade. That is just like TPP, it will try to promote trade among the countries. Further, it includes the supply chain resilience. Supply chain resilience here basically means that they will try to set up their own supply chain, be less dependent on China. That is, these countries should come together and create their own supply chains, and these supply chains should not be dependent on China for the supply of certain critical goods. It also seeks to boost the creation of infrastructure in the region. It will focus on decarbonization, and it will also focus upon simplification of tax and cracking down on corruption. So unlike the traditional free trade agreement which focuses solely on promotion of trade, this IPEF will also focus upon supply chain resilience, creation of infrastructure, decarbonization, tax and anti-corruption, and so on. Apart from that, the Trans-Pacific Partnership Agreement was considered to be less flexible as far as the member countries are concerned, which means all the member countries had to agree to a common set of goods and services, and on these common set of goods and services, they were required to reduce the customs duty. But the Indo-Pacific Economic Framework is more flexible as far as the member countries are concerned. Why is it more flexible? According to US, the US government has said that individually any country can become part of any of these modules. For example, let's say a country such as Australia, individually it will be required to join each of these modules, that is fair and resilient trade, supply chain resilience, infrastructure, decarbonization, tax and anti-corruption, and so on. On the other hand, let's say a country such as Japan, it may opt to join all the modules. So here it is up to a particular country whether to join one specific module or to join all the modules together. That is why we can say that the Indo-Pacific Economic Framework is more flexible in comparison to the Trans-Pacific Partnership Agreement. But at the same time, some countries have raised certain concerns with respect to the Indo-Pacific Economic Framework. The reason here is, see, when we sign a traditional free trade agreement, in this particular case, all the countries decide to reduce the customs duty on certain goods and services so that the trade between the countries increase. So the traditional free trade agreement will have certain binding rules, binding commitments with respect to liberalization of the trade. But when it comes to the Indo-Pacific Economic Framework, there is no binding commitments either with respect to the market access or with respect to reduction in the customs duties. Which means under this particular agreement as such, the US government is not going to give a commitment that it will reduce the customs duty on certain specified goods and services. The US government is not going to give a commitment that it will give more market access to certain category of goods. Now, for example, let's say we consider India, and if India becomes part of such an initiative, then there is no guarantee that certain products from India, such as textiles, leather products, etc., will get a favorable market access in US. Further, there is no guarantee that the US government will reduce the customs duty on textiles and leather which it imports from India. So that is one of the biggest concern and challenge as far as this particular economic framework is concerned. So as far as India's stand is concerned, as the title of this particular article highlights, undoubtedly Prime Minister Modi would be attending the launch of this initiative. However, so far, according to official sources, India has not taken any decision yet on whether to join this initiative or not. So probably we will wait for the broad contours to be unveiled by the US. So based upon the broad contours, once they are unveiled, we'll get a much greater clarity as to what benefits we'll get by being part of such an initiative. So based upon such a clarity, probably India may decide to join this particular initiative in future. But as of now, India has not taken any decision. So these are some of the important things that we should know as far as this particular article is concerned. The next article appears on page number 10. The article is titled as Infrastructure Projects to be Routed Through the Network Planning Group. See, last year, the government had launched the Pradhan Mantri Gati Shakti Master Plan. The basic objective of this particular plan is to promote coordination and to ensure the synergy between multiple ministries and departments which are involved in the creation of infrastructure. So as you can see in the budget 22-23, I had discussed all the aspects related to the Gati Shakti Master Plan. In the budget, we had discussed that the Department for Promotion of Industry and Internal Trade is a nodal department for the implementation of Gati Shakti Master Plan. Apart from that, the Government of India has set up an empowered group of secretaries headed by the Cabinet Secretary in order to review and monitor the implementation of the Gati Shakti Master Plan. In order to assess this empowered group of secretaries, we have also set up a network planning group. The network planning group comprises of representatives from 7 important ministries and departments, and its main mandate is to assist the empowered group of secretaries to review and monitor the implementation of Gati Shakti. A new development has taken place with respect to the mandate of the network planning group. According to new development, all the infrastructure proposals involving expenditure of more than 500 crores, they should compulsorily be routed through the network planning group. Now let's say the Ministry of Railways has come up with a new project proposal which involves an expenditure of more than 500 crores, and the Ministry of Railways is trying to connect 2 important places. So this particular project will first be examined by the network planning group. The network planning group will examine as to how this particular project proposed by the Ministry of Railways can be integrated with the projects proposed by other ministries and departments. And accordingly, the network planning group will then assess the empowered group of secretaries. So this is a new development that has taken place according to a recent notification issued by the government. So as far as the prelims examination is concerned, please make a note of the empowered group of secretaries and the network planning group. The next article appears on page number 7. The article is titled as Poor Recovery, Increasing Delays Mar the IBC Resolution Process. The article becomes important from the perspective of GS Paper 3 Indian Economy. So this particular article basically carries out a critical analysis of the Insolvency and Bankruptcy Code 2016, which we had introduced in order to counter the growing non-performing assets. Hence, as far as your prelims examination is concerned, one should be aware about the present working mechanism of the SARFAESI Act 2002, the important provisions of the IBC 2016, and as far as the mains examination is concerned, one should be aware about hits and misses of the IBC 2016. So based upon a discussion, you should be in a position to attempt a mains question for practice. The question here is, the implementation of IBC 2016 has emerged as a game changer in improving the financial health of the banks and thus enabled a virtuous economic cycle. Critically analyze. Further, you have 2 prelims-based questions for practice. See, as far as the topic of IBC, SARFAESI, and the present framework for resolution of NPAs is concerned, all of these topics I have covered in much greater detail in the DNS dated 2nd of July 2021. So as you can see, in this particular DNS, I have covered as to how the framework for the resolution of NPAs has emerged over a period of time. So it all started with filing of civil suits to recover the non-performing assets. And now we have set up a bad bank in the form of the National Asset Reconstruction Company Limited in order to resolve the growing NPA problem. Then in this particular DNS, I have discussed the working mechanism of the SARFAESI Act 2002. I have also discussed the working mechanism of IBC 2016. And then I had also carried out a critical analysis of IBC in terms of what are the benefits of IBC, in what way it has benefited us. And I also discussed some important concerns and challenges. See, as far as these benefits and concerns and challenges are concerned, you could directly incorporate these points while writing an answer to a question in the mains examination. So since this particular topic has already been covered in much greater detail, I'm not going to cover this topic once again, but I have incorporated the link to this particular DNS video in the description box below. So those of you who would want to know all the details related to the resolution of NPS, that is SURFACE Act, IBC, etc., you could go through this particular DNS video. With this, we have come to the end of today's discussion. Let us now have a look at the question for the day.